Good evening, everybody. Hope everybody's having a nice, I guess it's already fall, but it's like summer here in Pittsburgh today. Tonight we've got the great pleasure of having Dr. Barry Burns back with us. And I say great pleasure because every time we've had him on, he has provided some very interesting insights into how to trade effectively. So tonight he's going to show us how to trade based upon pure price action. So with that, Dr. Burns, welcome back. We're glad to have you here.
Well, thank you, Steve. I appreciate that. It is my pleasure. It's always been a pleasure every time that we've worked together, and I've always enjoyed your presentations and gotten a lot out of them, and always proud to share your stuff with my people, and appreciate you having me here to share my stuff as well. So, and to everybody here, we've got quite a few people here, so welcome. I'm thrilled to participate in the event today. So let's jump right into it. Let's see here. There we go. Oh, that's so cool. I'm not used to using this particular platform, so if I stumble through it a little bit, please excuse me, but I'll do my best. So have a little patience with me. I'm not exactly a technology expert. A good thing you don't have to be good at technology to trade. Just give a little introduction here about myself. I'm the author of Trend Trading for Dummies. I've received Reader's Choice Awards from Stocks and Commodities magazine for many, many years now, and I've helped other authors write their books, and I work with big companies like Ninja Trader and the CME Group. I've done education for them, written articles for eSignal, Metastock. My gosh, it's not showing up there very well. Anyway, that's supposed to be Metastock, and they asked me to work with them and create a plugin for Metastock, so I did that. There's a Top Dog Trading plugin. Presented to the Eurex Exchange, and oh gosh, all kinds of stuff. So if you want to see my bio, I don't want to talk about myself here too much, but if you want to see my bio, feel free to go to topdogtrading.com, click on the About Me tab, and you'll see my whole bio there. The one thing that is very important is that we do cover our legal requirements, and I want you to understand that these legal requirements, these regulatory statements, are not just legalese. They are really where your education begins. So if you're concerned about how do I know, if somebody is telling me the truth, or if a teacher is valid, or if they're just hypey, go back to these regulatory statements. These are here to protect you. I'm not going to read through this. I'm leaving it there for you to read, just giving you a little commentary on how serious you need to take this. These were created because people got hurt. So if you think of it that way, that means how do you avoid being financially hurt? Well, adhere to these regulatory statements. Take them to heart. Understand this is the beginning of your education, and I know a lot of you have been trading for a while. Unfortunately, fortunately, we're required to post these everywhere. Unfortunately, because we're required to post them so often, people become blind to them and stop looking at them, and that's really unfortunate. So this stuff is very important. It's real. This is where people get hurt. Don't get hurt, and understand all that is said here. The bottom line is most people do not make money trading. There's zero hype in this presentation today. In fact, I kind of dropped the ball because I don't have anything to sell you today. So I know you're all going to be bummed out about that, and you don't get too mad at me, but at the end of our presentation here, I actually have nothing to sell. I wouldn't even let you buy anything from me, so how's that? I'll give you some freebies. I've got some free stuff for you after we're done here, but yeah, literally, there's no offer for anything for you to buy. So I know, sad, right, Bill? So sad. So yeah, I have no reason to hype you because I got nothing to sell you. All right, so today's topic is price, pure price action, and then I'm going to incorporate some volume in there if we have time. So I added that toward the end so that as we're looking at our clock here, I know I've got, like 54 minutes left, and I'm going to adhere to that schedule very strictly. So we'll see how it goes and if I have time or not. If we do have extra time, we'll cover the volume aspect and how it relates to price action. And if we don't, well, then that's it. But there's going to be a lot of participation today. I want to really, really invite you to participate with me especially as we get going, because you're going to learn better for your sake. You'll learn better if you participate. We're going to have some quizzes, if you will. All right? Right? You didn't expect to come and get tested, did you? But you'll never get anything wrong. You'll either get it right or you'll learn. Those are the only two choices today. So my trading methodology, a big picture, my trading methodology for you, first of all, is I call my trading method the 5 energy trading method. So when I talk about energies, these 5 energies, I'm talking about the energy of money flow. So that's what I mean by energy. Money flowing in, money flowing out, the balance and imbalance of supply and demand. And I break that down into 5 subsets of money flow. And here they are. Number 1 is trend. That simply means the direction of the market, right? So we start there. And these are in order. So my trading method is literally a 5-step checklist. So I start with trend because that tells me which direction I want to trade. Well, makes sense. Let's start there so we know which side of the market we want to take. Number 2 is momentum. Now, lots of people know about trend, direction, but not as many people are familiar with momentum. This energy is very important because this tells us how strong the trend is. In fact, let's go ahead with a little engagement right now. Go ahead and type into the chat box right now, if you would, please, if you have this experience fairly frequently, not just once in a while, but I mean, it's a consistent enough problem that you'd like to get it solved. And that is this, where you can watch a trend go up and up and up and up and up until you get in. And god darn it, it just seems like when you get in, well, that's exactly when the trend ends. Type in something to let me know if that's a consistent challenge that you have, something you'd like solved. So Chad, Lou, wow, there's so many people typing in here. Let's see if I can move this chat box around so I can see everybody at the same time. I just want to acknowledge people. I am here with you live, by the way. You probably know that already. But Coleman, Sadrach, Chad, Lou, John, Nancy, Bill, Tom. Yep, okay, so quite a few people. All right. 2 reasons that happens. 2 reasons, at least 2 reasons, okay, but I'll give you 2 of them today. Number 1, notice how I asked the question. We're going to do a lot of the Socratic method today, meaning I'm going to guide you to the truth. I'm not just going to tell you stuff. I want you to discover the truth. So we all know the slogan, the trend is your friend until the end, right? Or at least most people know that. The trend is your friend until the end. Now, what does that really mean, though? What is the learning moment of that slogan? It's not just about trend. Most people interpret that to say, well, just trade in the direction of the trend. Okay, that is half the truth. Yes, you're correct. But the more important, poignant point, ooh, that's kind of a good alliteration, more important, poignant point, gotta say that 10 times, is about timing. Trade early in a new trend is what that is really teaching us. So if you listen back to the question of how I said it, how many of you can watch a trend go up and up and up and up and up until you get it and then it turns around? Well, the question implies that you've been watching this trend go up for a long time. So guess what? Now your statistical probability has shifted. Well, the longer the trend continues, the less likely it is to continue from a statistical model. Therefore, we want to get in early in a new trend, as early as possible, because the trend is your friend until the end, and the longer it goes on, it becomes your enemy, or some would say frenemy. Okay, so if you're getting in late in an old trend, yeah, you're buying in the direction of the trend, but it's no longer your friend. So that's one solution, is timing how early or late you are in the trend. The second solution to that problem is the second energy, their momentum. And a gentleman in Australia taught me this many, many years ago. And he said, okay, Barry, because I was having this problem too. By the way, every problem, everything I bring up today, I've suffered through. I am teaching you from my losses, okay? I have zero ego here. I'm totally transparent. I've made every mistake in the book way more times than I should have, okay? I was actually a slow learner. But, you know, you finally learn. Pain is a great teacher. And for me, it was the pain of losing money. And I've been doing this for 50 years, literally, because my dad was a stock trader, and he started teaching me at our dining room table when I was 8 years old, knee high to a grasshopper. So pretty unusual story. Maybe one day I'll tell you about that. But for today's purpose, this Australian trader, he said, yeah, Barry, you got to understand, are you trading a trend that is strong or weak? And I never made the distinction. In fact, what he did was he kind of did the same thing. He said, there are two kinds of trends. What are they, Barry? And I said, well, up and down. He said, yeah, but there was another distinction too, and that is strong or weak. Well, I never was taught that before. He said, if you're in a weak trend, even if it's early in the new trend now, even if it's early in a new trend, but if it's weak, you will be stopped out. And so only trade strong trends. So I literally took a Post-it note and wrote that question on the Post-it note. Is this a strong trend or a weak trend? I put it on my 7 monitors where I trade, and I would look at that every single time and ask myself that every single time before I took a trade. Right? And that's the energy of momentum. Momentum is velocity times mass. And so in trading, velocity is the speed of the orders coming in. Right? When I was at the CME, we could literally see and hear and we could actually feel viscerally the energy in the room. So how fast are those orders coming in? And then mass I equate to the volume being traded, the size. And especially I like to see the big institutions involved. Okay, then number 3. So 1 and 2 is the type of market we want to trade. Think of it like a like whitewater rafting. Anybody been whitewater rafting? Okay, so the kind of market that I like to trade is like that. A river that is like a whitewater river. And I'm not going to swim against that current of currency. Oh, that's a good little alliteration too. I'm coming up with all these great terms here. Current of currency. So no, I don't want to be a trading salmon, in other words, right? I don't want to swim upstream. I just want to jump in that raft and let the river carry me. I'm not going to say trading is ever easy, because it's not, but that's the easiest way to trade. And you're not going to beat the institutions because they got the big money. So if you can't beat them, join them. So that's what you got when you're early in a new trend and has a lot of momentum, a lot of big money coming in. Then the only question is timing, when to get in. And that's where my cycle indicator comes in. And by the way, I normally do sell this. I actually do sell the cycle indicator, but I will give that to you guys. I'll show you how to get it for free today at the end, right? And I won't charge you for it. So that's how to time your entries. This indicator actually catches every single cycle high and low. We don't trade every high and low, but it teaches you the cycle highs and lows. It shows them to you. Then step 4 in our trading process is support resistance, obviously. Buy off support, short off resistance. And then the 5th and final energy that I look at is the next higher time frame. I call it the energy of scale. And again, it's literally just looking at the next higher time frame, make sure I'm trading in the direction of the next higher time frame as well. So we have confirmation on 2 time intervals, right? 2 different perspectives, multidimensional. Okay, so that's my overview of my entire 5 energy method. Now, let's bring it way back down to the basics. So even if you're a complete newbie today, you're going to be able to follow this. And if you're a complete un-newbie today, the first few slides are going to be a little too basic for you, but hang in there, because we're going to build this thing block by block. And I'm going to show you how to read price action bar by bar, a whole chart of price action. So bear with me a little bit here if this is a little below your pay grade. And if you're a newbie, well, you're welcome. Okay, so 1 bar price logic. We're going to start with 1 bar, then go to 2 bars, 3 bars, and then we're going to look at a whole history of bars and learn how to read them. So we can read a chart like a book. Anybody have the experience where you look at a chart and it looks just like a Rorschach ink blot test? It's just chaotic. It looks subjective. It's not subjective at all. Every chart tells a story. Okay, and that's what we're going to learn today, is how to tell the story. So we start out with the alphabet. So this bar, being green, candlesticks. I love candlesticks, just like Stephen does. So this means that the bar opened at the low. Let's see if I have a pointer. Can you guys? Yeah, good. You can see my pointer here. Okay, cool. So we opened down here at the low. We closed here at the top of the real body, the green part, and we reached the high there. All right, came back down a little bit off the top. So this, in essence, is a bullish bar. That's the sentiment of this one period. And whether it's a 5-minute bar, a 2-minute bar, a 144-tick bar, a daily bar, whatever it is, during that period, the market is being bullish. Okay, opposite. So here we go. I told you this was going to be basic. We opened up here, we closed down here, and the market reached that low. So again, because the market opened here and closed here, during that time period, the market was bearish. It's a very bearish bar. Now, what about this one? Okay, and we're not going to go through Japanese candlesticks linguistics today. I'm just going to go through the logic of candlestick bars. Just purely going to talk about the logic. So now this one, where did my cursor go? There it is. We've got a very narrow real body, right? So just looking at this one bar, now again, we can't trade one bar by itself, but I'm just doing building blocks here. So what this essentially means psychologically is we had a low here, we had a high way up here, and we opened and closed down here in this area. So that means, now I'm going to tap into a little market profile terminology here, even though I don't trade market profile personally. It is good stuff, and it does have some really good understanding of how markets work. So this wick, or this shadow, whatever your preferred term is called a rejection of value. Rejection of value, market profile term. So the market participants, they tested all these prices up here and rejected them, and by the time this period was done, the market said, nope, you know what? We're valuing the market down here. Market profile says that the markets are an auction place, and it's a market, whatever it is, whether it's Forex stocks, futures, E-minis, whatever, it's worth what people are willing to pay for it. All right, so just like, remember the Seinfeld episode where they have John F. Kennedy's golf clubs for sale, right? It's whatever someone's willing to pay for it. It may be a book value, it may not. Somebody might be very emotional about an object that they want, and so they're willing to pay more than the book value. Well, markets are the same way too. That's why Alan Greenspan coined the term irrational enthusiasm. So this one means, right, they rejected these prices, so for this time, this is a bearish candle, bearish. And then opposite pattern, this one bullish because it rejected these prices down here and closed up here. By the way, when I have a really narrow range bar, or very narrow range real body, I should say, I don't really personally care if it's red or green because it's so close. The markets are not that exacting, right? The markets are huge global places. You got to understand, you know, multi-millions, billions of dollars are being traded every day in every country of the world, all over the world, day and night. And not everybody is all together on the same page, right? So you got to make an allowance for a bit of randomness, noise, whatever you want to call it in the markets, and not, you know, we've got everything under computers now, so we can measure everything to the pixel. Yeah, that's being, you know, overly analytic. That's not how the markets work. Okay, so let's go to a two-bar logic now. Ooh, getting complicated here. So now this two-bar pattern is a bullish pattern. Okay, this one bar was bearish, but this bar is bullish. And this bar, we would say, has invalidated the bar before it. So the green bar has invalidated the sentiment of the market the bar before. And looking at it the other direction, same thing here. Now we have a bearish bar that has invalidated the bullish bar before it. So this is what I would call a two-bar bearish pattern. Right? And again, I like to use the word validate or invalidate the bar before. Because one bar and, you know, a $20 bill will get you half a cup of coffee at Starbucks. So not enough to trade. All right, now, another two-bar logic. So we have a bullish bar, and then our second bar is bearish. Why? Because, again, rejection of value, this long tail up here. Some people call these pin bars. You can use the Japanese candlestick traditional terms if you want to. But we're just trying to keep things simple today without getting too involved. We're just following the logic of it, so I'm not going to use the terms. But so we closed up here. Went up here, tested, came all the way back down, and closed all the way back down here. So this bar invalidated the bar before it. Likewise, now this is a bullish invalidation pattern. Bearish bar, the red one, tested down here, this long wick or shadow, rejected all of that and said, nope, now within these two bars, from one bar to the next, The market has changed sentiment, meaning the market participants now have changed their mind on how they feel about the market. Now, what about this one? So the left bar is bullish, and the right bar is just neutral. I call it a spinning top or whatever. But there's two factors. Number one, the range of the bar is just very narrow range. That's really the main thing. The real body is narrow range, and the entire range of the bar from high to low is narrow range. So it's neutral, and therefore we are still in bullish mode. So this is considered a neutral bar, but for a two-bar pattern, we're still in a bullish sentiment. All right, now that we got the basics of the very, very simple logic, let's go through these bars, just point out a few of them, and ask the question. Did each one of these validate or invalidate the price action of the bar that precedes them? So, what about this one? Now, this is where I want you to participate. This bar right there, what do you think? Did this bar validate or invalidate the price action? Okay, and I'm not just talking about the one bar before, but the price action before it. Go ahead and let me know. Go ahead, Casey, thank you. Nancy, good. Ed, okay. Lou, Warren, very good, thank you. All right, bit of a trick question. Bit of a trick question. I want to point something out to you, and that is this. That we as human beings have an inbred bias. All right? Now, again, don't be offended or don't feel bad if you got it wrong. The point is that we're here to learn, right? Not to be right or to be wrong. So this bar actually is a neutral bar. We did not get any long wicks. It's a narrow range bar from high to low. Doesn't really engulf the bar before it. It's really just pretty neutral. Now, the reason that a lot of people would say that it invalidates is because you have the advantage of seeing the future. Another reason might be because it's green. Don't get, all caught up on green and red, right? Again, we have human beings have a tendency to get caught up on green and red. Sometimes green's important. When is green important? When it's a wide range bar and when the real body is wide range. You need both of those. Wide range bar from low to high, and the real body is wide range. Now, so that is a bullish bar. That, just neutral. We all would like to say, oh, that invalidates the price action before it. Why? Because our brain automatically sees this. But no, in actuality, that to me would not be a long trade. Now, I would have to deal with, oh, I missed this trade. No, I didn't miss the trade. That's not proper terminology to use. To say you missed a trade means that there was a high probability situation to trade. Just because the market went up does not mean there was a high probability trade. When I use the term trade, I mean there was a high probability statistical advantage to me. And if there wasn't, whether the market goes up or down, there was no trade. The market just moved without being preceded by a high probability situation. And so you didn't miss a move. You cannot use that terminology or you will drive yourself nuts. You did not miss a move. There was no move to be caught, right? In the operative term, there's to be caught, meaning it was preceded by a high probability trade. You start thinking, oh, I got to catch every move, you are going to drive yourself crazy because that's unrealistic and it'll never happen. In fact, you will not catch most moves because most moves are not preceded by a high probability trade or a high probability scenario. Most are not. This is why, one of my favorite sayings is that professionals outpatient amateurs. We're not trading for action. I've been there. I used to trade for the action. I used to get adrenaline rush off of trading. I learned to just, I got a PlayStation, an Xbox, and I use that for my adrenaline rush. I go train in martial arts. I do that for my adrenaline rush. I don't trade for adrenaline. Because if I do, I lose money. And that makes me very unhappy. All right, so a little trick question there. But I wanted to, again, involve you in it so that you hopefully would have a little learning moment that'll help you in your real trading. Now, hopefully you'll trust me enough to, after that one, to answer the next question. What about this bar? Does this red bar validate or invalidate the bar before it? All right. There we go. Yes. Right. Good. Dash, Keshi, Ook, Ann, Jake, Warren, Mike, Ed, Bill. Right. Jim. Okay, good. That one does invalidate the bar before it. Yes. Yes. Very good. Muy bien. Ausgezeichnet. Yes. All right. And I think you guys all get it. I mean, you're candlestick people anyway. So it invalidates it. It's an engulfing pattern, if you will, but it engulfs, the real body engulfs the bar before it. The real body is wide range. It closes way below the open, and the entire body is wide range. Notice that I'm constantly making the distinction between the range of the real body and the range of the entire bar. All right? So, good. Now, what about this one? What about that bar right there? Is that a bullish pattern or bearish pattern? Let's do that. Neutral it is. It is a neutral bar. Very good. Sadrak, Jim, Warren, Nancy, Ed. Yep, it is a neutral bar. Very good. Indecision, Paulette. Excellent. So, now, the reason is because it's average range. It's not narrow range, but it's not wide range. It's a doji, open and closed at the same place. But it doesn't change our sentiment. And so, therefore, we are still in bearish mode, but the bar itself, I would say, is fairly neutral. Exactly. And then I think we've pretty much, hit a dead horse. But what about this one? Just for fun and giggles, does this one validate or invalidate the bar before it? Right. Good, Casey. Good, Ann. Good, Lou. Investigation. Right. So this, where did my cursor go? There it is. So it keeps going away on me for some reason. If I don't keep moving my cursor, it goes away on me. So yes, this green bar invalidates the red bar. That's a bearish bar. Now, here's the other thing. We got to take these bars in the context of where they are. Remember we said that we only want to take trades early in a new trend. So we've already been coming down for quite a while here. All right, and so even though you get bearish bars, now they're no longer quite as significant in the sense that they're still bearish. Yes, they are, as a one-bar pattern. But where does it appear in the context of the entire trade? Well, it appears, after we've been going down for a while. So now when we get an engulfing pattern, then we say, okay, now we're invalidating that, and it's more significant for us. Okay, I'm not going to spend a lot of time on this. You guys are getting it. So I'm going to just go ahead and share with myself, because I really would like to get to that volume stuff. So here's how we count bars. Neutral, neutral, bullish, neutral, which means we're still in bullish mode. Bullish, 5 is bullish. Keep losing my cursor here. 6, kind of, now sometimes don't be afraid or don't be shy about saying I'm not sure. I say I'm not sure in trading all the time. And by the way, this is one of my principal cardinal rules of trading, is that if something's not clear to you, and there will be a lot of times things are not clear, then you default to do nothing. All right? If you're not in a trade. If I'm not in a trade and things are not clear to me, I keep my powder dry. I do not trade. I monitor my self-talk. If I'm thinking, well, it kind of looks like this, it could be bullish. Once I hear myself talking like that, immediately I'm like, wait a minute. I am speaking from a position of doubt. I am speaking from a position of uncertainty. Therefore, Barry, do nothing. Wait for the best setups. Only trade the best, most clear setups that absolutely positively meet your rules. And as soon as I hear myself hemming and hawing, I say, nope, just don't do anything, just wait. Outpatient the amateurs. But, so in this case, what's the deal? Well, it opens and closes in the lower half of the bar. The bar is not narrow range, kind of medium. Then I look at this one. That one does engulf this one. So, you know, at least the real bodies do. I'm mostly concerned personally about the real bodies. That's where the real action of the market was during that period of time from the open to the close. The wicks, to me, the shadows, are where the market has tested value. So now we're in bearish, bearish, neutral, neutral. So we're still bearish, bearish, bearish. That is a bearish bar. Bearish, bearish, neutral. Notice how they're getting a little more. Okay, now we switch to bullish mode. Just go through that one fast. Now, let's do another quiz. Based on the price formation, the logic, the basic logic of price action bars, here on the hard right edge of the screen, okay, notice I got my little blue arrow there. What would you expect to happen next? Type in, what would you expect to happen next? Now you can't see the future. I've taken away the future from you, because this is how we got to trade. All right, so what would you say? Here we go. All right, so thank you, John and Lisa and Elvis and Nancy and Mike and Lou and Tom and Diana and Jim and Warren and John and Paulette and Casey. Too many of that I can. Okay, Tom, I don't know. Awesome, I love that. That's great. That's great. If you don't know, that's cool. Then just say you don't know. All right, so very good. Well, let's see what happens now. Now we'll play God. Okay. All right, so for those of you who did say gap close, that's exactly what we got. And you win, you get 100 points. All right, what do the points get you? They're Top Dog Trading admiration points from your host, Barry Burns. And again, that in a $50 bill will get you half a cup of coffee at Starbucks. So how would I analyze this? I analyze this as this. We have a gap, obviously. Very good. And then we've got our narrow range real body. But look again, the long wick here. And again, it's got to be a pretty wide range bar for me to consider this. Not a narrow range bar, but a wide range bar. We got a wide range bar from high to low. And we get the open and the close in the top, say, third of the bar, and it's narrow range. Then this is a rejection of value. What it really did was we came down and retested this low. You see, market participants, what is this? This is a 5-minute bar. So market participants saw this low. They said, okay, that's our low of the day so far. The market tested it and rejected the low of the day. And that's what that bar says. So with that rejection of the low of the day and a gap, I'm saying, yeah, that's a bullish pattern. Now, because people ask all the time, well, how do you know if the gap's going to close or not? How do we know if the window is going to close, as the Japanese like to say, or not? Well, you got to look for these kind of patterns, because some are gaps and goes, right? So, very good. You guys are doing awesome, by the way. Okay, let's do that one again. This is fun. Let's do it on the right edge of the screen. Now we have no gap. Okay, the market's already opened. And what's going to happen next? Hard right edge of the screen. What do you think? Type it in. And says down. Diana, Warren, who else? You guys are still brave, man. I'm putting you on the spot. And I appreciate you playing with me here today. Thank you very much for that. Gary, Casey, Lisa, Tom, Blair, Jimmy. I'm missing some names because it's going by so fast. It's scrolling. But thank you so much for participating. It's great. And you know, you'll learn more by participating than just sitting by and watching, right? Okay, so if you said down, again, you're a winner. Now you get, heck, I'll give you 1,000 Top Dog Trading Barry Burns admiration points for that one. So we had a big engulfing pattern. Okay, that's a big mamacita engulfing pattern, 2-bar engulfing pattern. Again, retesting high and lows. Notice how we're using support resistance in conjunction with the candlestick patterns. In my mind, support resistance is part of price action. And the markets definitely look at support resistance all the time. So this now is the high of the day, right? That's where the day opens. You can see the vertical dashed line there. People are looking at us the high of the day. We come back, we test it, and then we get this big engulfing pattern. So yeah, for me and my house, we're going short. Absolutely. Very good. Let's do another one. What the heck? We're having fun here. Hope you are. Now what's going to happen? Oh my gosh. Okay, we're trying some different scenarios here. All right. Somebody predict the future for me. Bring out your crystal balls. Gary, Lou, Coleman, Casey, Ann, Warren, John, Ed, TQ, All right, Lisa. All right, very good. Awesome. You guys rock. All right, now let me share with you something here. Actually, let me go back because I purposefully did not put this in. Look at this high here and look at that high there. Okay? I did not draw the line in. Now, on the next slide, I draw it in. That's that high. Okay, and the other high, well, it's off the screen there. So here's the learning moment of this. All right? With this wide range from high to low, wide range from open to close bar, very dramatically bullish bar. And here's the extra lesson on this slide. It broke through resistance and it closed above resistance. So it just sliced right through. It sliced it like butter. Sliced it like butter. And when the market slices through support or resistance like butter, that means it's on a tear. Because it's normal for the market to at least pause or bounce off. And even if it doesn't bounce off of it and put in a high, and it's going to keep going up, quite often the market will at least put in some narrow range bars there, slow down because, well, in practical terms, because there's some people taking profits and there may be some amateurs shorting. But here, nope. It just slices through like it didn't exist, but it clearly did exist. And by the way, yeah, look at this one. Here we have a wide range red bar, just as much as that's a wide range green bar, but look where it stopped. It stopped at this support back here. And that's the difference. And then narrow range, right? So that's what we would expect if it's... Now here, this to me doesn't tell you if it's going to go up or down, but when we get here and here, okay, now it's bouncing off. This one, shoo, nothing but net. Okay, well, we definitely have time for the volume, so you guys, you know what, I should have expected that. You guys work with Steven, so you know Candlestick, so this comes natural to you. This is actually very beginner stuff, much more basic than what Steven teaches, so more for newbies, but hopefully what I like to do is share the logic of it. You know, there's all the great candlestick patterns you can get into in the details. I'm just digging deep into what does the logic behind the pattern mean. So since you guys are a little more advanced and went through that, you went through that like butter. So let's go to volume logic. All right, let's look how we can use some volume. And this stuff's a little more intermediate level. Okay. So we're going to use this with the 5 energies, the little quick little 5 energy that 5 energy method I shared with you and outlined at the beginning. So now here's what we're going to do. We're going to distinguish between large volume and small volume. And we want enough volume, but not too much volume. Okay, we'll come back to that. It's always got to be a little caveat in there with trading, doesn't there? It's always like, can't it just be one way or the other? Nope. Always one of my favorite sayings. Well, actually, this is an ancient Chinese saying. But today, since we're doing candlesticks, I'll call it an ancient Japanese saying that I just made up. The dollars are in the details. It's these details that really matter. It's the details that'll make you the money. So we want to look at large volume versus small volume. We want enough volume, but not too much. And not just large volume, but here's the other distinction. We want smart volume. So you might have big volume, but that's not enough. We want smart volume. What do I mean by smart volume? Professional participation. I don't want just, because you could get a lot of volume and they're all amateur traders. Okay, amateur traders. And that's where all the amateurs are being led astray at the same time. But as we already know, and I mentioned at the beginning, most people lose money. So if you get all the people who regularly lose money, is that what you want to do? Do you want to follow them? No. You want to follow the minority of people who are making money, and that's the professionals, the smart money. So just big volume is not enough. This is where we split hairs with the dollars that are in the details. We want to compare professional volume and retail volume, but retail volume is a nice term for amateur volume. So here's how we do it. We're going to get into a little tape reading now. A little tape reading. So this is a time and sales window, as you can see, using TradeStation. You can use various charting platforms for this. Just had to use one, so I use TradeStation. Now, when I set up my time and sales window, the first thing I would need to share with you is that I only am going to set it up to show trades. With most time and sales windows, it'll show you the trades, the bids, the asks. For me, for purposes today, I don't want to see the bids and the asks. I don't want to see them. I don't care about those for this purpose. Now, they can be used in other ways, but for our purpose today, no. I just want to see the actual trades because this is the commitment of money. This is where people have actually committed their money. People are very serious about their money. So when their money leaves their hands, that's when they've made a commitment. They're not on a date. They're now married. You've heard people being married to a position, right? So now I know there's a commitment there. That's what I want to look for. Now, you can also, some charting platforms allow you to do this. Some do, some do not. You don't need this, but there are some that will allow you to actually then take the time and sales data and plot it on your chart. All right, so here's my volume on the bottom of the chart. Notice my volume histogram down here looks different than most people's. Because most volume histogram have volume vertical lines under every single bar. Mine doesn't. Why not? Because in this scenario, I'm only charting what's called block trades. Block trades. Now, this is the NQ, the NASDAQ 100 futures. And so I set it, and this is another thing that I went in and I changed, where I said, okay, TradeStation, I only want you to actually plot trades on here that are 20 contracts or more. If it's one contract, I don't want you to show it on the window. If it's 5 contracts, I don't want you to show me. If it's 10 contracts, I don't want you to show me. Why? Because I want to see only the smart money. And most retailers, most amateurs, cannot afford to trade 20 lots, 20 contracts in a single trade. They don't have the size trading account to do that. So for all the people who don't know what they're doing, I mean, again, I'm not being disparaging here. It's just a black and white fact. What I'm doing is just filtering out. Again, it's not a perfect system, right? But at least we're filtering out all the people with small accounts, which means most of the people who are not making money. And I'm looking for a preponderance of the evidence of people who have a higher likelihood who are making money because they have larger accounts, and so they're probably doing good. It's not 100%. So all that I'm trading, or I'm looking at volume here, is these are the block trades. This is where the big money's coming in. Okay, and I can see that underneath. Pretty cool, huh? Now, if you really want to get crazy, this is even a more sophisticated scenario. You can bring up two time and sales windows in one. So what we got here is, notice the size of my one on the left. All small contracts, 1 and 2 contracts. And that's how I set it. So this one I set, now I only want the charting platform, I set a filter, is what it's called. I filtered it so it'll only show me trades of 1 and 2 contract trades. You really think that, most institutions, professional traders are trading 1 or 2 contracts? Probably not, right? It's not worth their time. On the other hand, and so that I got over here, and then I create another time and sales window, but I just put in different filters. Okay, and this one, I think we set it for 10. Yeah, this one we set for 10. Alrighty, now look at the difference. This tells a story. This tells a story. And by the way, notice the prices are the same, right? 1205.75, 1205.75. So they're trading the same prices within a tick or two, get a little slippage or whatever. But what's the big money doing? Somebody type it in. What's the big money doing? First one to type in what the big money is doing, buying or selling. Those are your 2 options. It's a multiple choice question. There you go. All right, Lisa's the first one, I think, who typed it in. Wait, let me double check that. I don't want to bypass anybody. Oh, Bill's the first one. Gosh, you guys are fast. Wait a minute. No, let's see. No, Lisa was the first one. Okay, I had to scroll back up. So Lisa, yeah, you are the first winner, and therefore you get, I'm going to up it to 1 million Top Dog Trading admiration points. So yes, buying. What are the amateurs doing here? Yes, good job, Lisa. What are the amateurs doing? Yeah, they're selling. Let me ask you a question. You see this. What do you want to do? What do you want to do? Yeah. Does this give you an edge? Seeing this, does this give you an edge in your trading? Would this give you an edge in your trading if you saw this? Yes or no? Yeah. I call this an invisible edge because most people don't see this. Most people don't see it, but you do. Very few people use this technique. Some do. Professionals do, I can tell you that. Well, not all professionals, but there's many different ways to groom a cat, but it is one of the techniques that professionals use. I use it, and my goodness. I mean, again, talk about the whitewater rafting example that I mentioned. You know, we talked about we want to go with the flow. We can't beat the professionals, so we want to go with them. If you can't beat them, join them. The question then, of course, is, well, of course, Barry, that's obvious, right? But the question most people don't answer is how? If I can't beat them, how do I join the professionals? How do I know what they're doing? Right there. That's how you know. Now, I saw a question fly by here. The scroll, you know, you guys are great. Thank you for participating so much, but I'm not catching all the questions because they're scrolling so fast. But I did see one go by, people asking about how do you choose the lot size. Great question. And by the way, you can do this with stocks as well. This is futures example, whatever. But so you have to, yeah, you would use a different lot size or a different share size for various markets. So for example, for the E-minis, I use 50 contracts, and sometimes they'll even just put up 100 contracts. 20 is not that much for the E-minis. 20 is a little better for the NQs. Now, 1,000 shares isn't even a lot if you're trading stocks, okay? And there are professional traders who I know, not like super huge, but you know, they'll trade 100 shares or even 1,000 shares, and so there are professionals who will trade that small size, and they're making money, and they're consistently profitable. So we're not just looking for professionals, we're looking for the really, really, you know, big money, right? And we don't need to see every professional trader's trade. Sure, I've got a friend who trades, he makes money consistently. You know, he only trades like 100 shares to 300 shares in stocks, and he makes money. So he's not going to show up for me. That's okay. I'm not looking for people like him, even though he's a winning trader. I'm looking for, you know, the institutions, right? Okay. So, gosh, we moved through this pretty fast. I can't find my cursor here again. There it is. All right, I got to activate the chart to move in. Okay, one more little distinction here. Now, here's another distinction. Let's take it to another level. We started out real simple, and now I think I'm getting some new stuff for you today, so I'm glad. Now, we can also use a different color to delineate whether someone is buying above or below the bid or the ask. So this is where you see if people are being real aggressive in their buying or real aggressive in their shorting, or quite frankly, it could be they're getting a little slippage, but guess what? If they're getting a little slippage, that means that you're probably in what brokers call a fast-moving market, which is sometimes an excuse that they give you for why you didn't get the price you wanted when you put in your order. Like, hey, I put in this price, but I didn't get filled there. And all the brokers are trained to they have a mantra. It was a fast-moving market. Even if they don't know, even if they don't look at the market at that time, they'll just say, oh yeah, that was a fast-moving market, and they don't know. Maybe it was, maybe it wasn't. They're just taught to say that. But sometimes it is, and this is one way that you can determine. So this, there we go, got my cursor quickly this time. So okay, I got green for buying here, and now I put in lime green when it's above the ask, when the buy is above the ask. So somebody bought here 30 contracts. By the way, this is the important part. These 30 contracts is one trade. They're not sizing in with 30 contracts. They're not sizing in with smaller contracts to get a position of 30. No, that's one trade. One trade. So that tells me that they got some slippage there, or they were willing to actually get a worse price. Okay, it's just a tick. It's only $5 for them, but times 30. Okay, and the same here. I paid it's kind of harder to see here, but red is your buy or your selling, or yeah, selling, and then magenta is where they're getting a little slippage. Okay, different color for selling below the bid. Now we can add one more thing. So I decided on this one, okay, 20 contracts is all I'm going to see. That's what I put in as my filter. 20 or above, I should say. 20 or above contracts in a single trade. But then I've got another column over here. In that other column, I set at 50 contracts, and I have it bring up this little indication in this column that it's a block trade. All right, so I can have two different quantities. Only seeing the orders that are actually filled at 20 contracts or more for one trade. And then I want to see block trades, which I've now set at 50 or more. Now we're still in the NQ. 50 contracts? That's a lot. That's a big trade. All right, so I'm going to give more weight to that. And I could just look at the numbers, but it's kind of cool. It's kind of nice. And it's just easily, visibly, immediately recognizable when in that right-hand column, it just brings up block, and I put it in a black background. Okay, so now we're going to always get, not always, but we're going to often get a mix of red and green. If you look at the red and the green, you see a preponderance of red. But if we look at our block trades, they're all red. They're all red. And so that takes the distinction to even a further level. Because, hey, our professional traders, do they win on every trade? Nope. They're wrong sometimes too. We all have losses. So that just because you see, a professional trader come in, by the way, this is another key point, really important. I almost forgot to mention. Just because you see one block trade come in, or one big-sized order come in, now that and a $100 bill will get you a quarter cup of coffee at Starbucks. It doesn't mean diddly squat, because pros have losers too. So what we're looking for is what? A pattern. We're looking for a pattern. So now this could be, someone accumulating position, but they're accumulating it at 35, 22, 100. Okay. And all three here, look, these all come in within 2 minutes of each other. Boom, 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 boom. So now I'm taking that seriously. I'm taking that seriously. Yep. All right. Let's see. I think we got one more. Oh, yeah, here we go. Okay. So this is it. So now I'm going to just show you an example of where using the block trade indicator can help you on the chart. Again, you don't need this. You can just glance over at your time and sales window, but if your charting platform allows you to do this, I just think it brings more clarity. I'm a big stickler for clarity. So here we've been trading in a range. Trade a range between the value area high, that's what's kind of covered up there with my Bollinger Bands, VAH, value area high, that's the magenta line there, okay? And that's also the blue line. See, I know my colors that I've created, so I just happen to know that blue line is also the central pivot. So the central pivot and the value area high, they came in as a cluster, and yesterday's close, that's the gold line there. So we've got a triple cluster of the value area high, the pivot point, and yesterday's close. In the market, wow, I mean, some people are looking at the close, some are looking at the pivot point, some are looking value area high. This is why clusters work. Again, I'm really big into the logic of explaining why things work. So why do resistance clusters work? It's because you have different people, different traders out there using different technical analysis techniques and using different support resistance levels that are important to them. So when you get a cluster of three different types, that's the important point, three different types of support resistance, you've got three different groups of traders all seeing that, it becomes a self-fulfilling prophecy. You got more masses who are looking at that level as, gosh, I don't know if the market's going to break through here, and so they're going to take profits into it. Or, conversely, they might actually say, oh, that's a good sell level, and they short off of it. So you got masses and masses of people, it's more likely to hold. And so it does. And this down here, yesterday's low, well, everybody in this parakeet looks at yesterday's low, so that's always going to be significant. So, yep, boom, 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 and it tries 1, 2, 3 times to break through. They say 3 times the charm. Nope, not. Goes down here again. Now, breakout. Okay, big challenge. One of the biggest questions I get from breakout traders is, Barry, how do I determine if the market is going to really break out when we get a breakout, or if it's going to be a false breakout, if it's going to fail? And one of the best answers I have is the block trades. So no volume bars, no block trade bars come in until that point. None, the pros were not trading this stuff. It's just choppiness. Wouldn't trade that. But when the professionals come in, bam, they're trading the breakout. And yep, now I'm saying, oh, okay, so I believe this this breakout trade will continue and is not going to fail. Why? Because a bunch of professionals just came in with their money, and they've committed their money, honey. Where do we go? Yesterday's high. Again, everybody in his parakeet's looking at that. So here's what I was talking about before. Yeah, it's not significant. The market pauses there because everyone's seeing that. People are taking profits into it. Maybe some retailers are shorting off of it. So it pauses, which is normal, and then it continues on. So that's it, my friends. I made it with 2 minutes to spare. So as I promised, I got nothing for sale today, but I do have a free, I'll just give you one of my courses today. How's that? So it's my 5-day video correspondence course. This is 5 videos. Each one's about 20 minutes, so it's a nice brief course. You can go through it real quick. And there's an interactive quiz at the end of each one. So just like today, where I did quizzes, I'm a big believer in what I call feedback loops, because I believe that's the best way that you learn. So many times in trading, we read books, watch videos, get courses, but we're never tested on them. And just like in school, you got to get your test because that's what shows you whether you learned it or not. And if you didn't, that's okay, but then you can course correct, right? So in my education, I'm always providing these feedback loops and the course correction to make sure you got it right. So each video has a quiz at the end. In this course, it's not only theories and ideas, but I'm actually giving you one of my favorite trade setups. It's called the rubber band trade, and that's going to be in video number 4 of this correspondence course. That's a trade you can actually take and start trading. Obviously, trade it on a simulator or demo account before you prove to yourself that you can make it work, but it's a very practical trade. Before people buy my courses, I want to actually give them something, and I like you to, if you do decide to buy my courses someday, I'd love you to do it with money that I've already made for you by giving you value in advance. And then I promised you my cycle indicator. That is also given away. I'll give you that for free. It's a modification of a current indicator on your charts, but I've got to teach you how to trade it. Again, the dollars are in the details, right? So I do that in a 1-hour tutorial, just like this. We take 60 minutes, get the indicator set up on your chart, spend a little time doing that. Works on any charting platform, by the way. And so whatever charting platform you are using, this indicator will work on it. And this one shows you how, or not how, but when to enter a trade. So the timing, this is what I use to trigger myself into trades, whether getting long, getting short, and also triggers me out of trades. So you can get all that by just going to topdogtrading.com/free.html. And I see Stephen has already posted that link in the general chat box, so thank you, Stephen. And you go there and you get all that. You get all 4 of those things by just going to that same link. So that's it. I nailed it right at the top of the hour. I've got 6 o'clock here in La La Land. Oh no, 6:01. I went 1 minute over. All right. Well, thank you very much, Stephen. Thank you, Becky. Thank you, everybody at the Candlestick Trading Forum. I really appreciate your invitation. Hope you all found value in the tutorial today. And oh, by the way, since I've run out of time, you see my email there, Barry@topdogtrading.com. If you have any questions you'd like to ask me about today's tutorial or anything else, feel free to send me an email. That's my direct email address, and you'll never bother me. I love corresponding with traders. It's actually fun for me. I enjoy this. So thanks again. And Stephen, I'll turn it back to you.
Very good stuff. And as you can see, everybody, this is just kind of common sense stuff put into a practical method for trading, which definitely puts the probabilities again in your favor. So try it out. It's free. Yeah, I think you're going to get a lot more than you expect out of his information. It's been good through the years. So with that, Dr. Berry, thank you very much. Everybody have a good evening.